Today's inflation day. Are we going to get a higher inflation print, or did we just see the peak of inflation, and what does that mean to the market? That's what's coming up next on 3 Minutes on Markets and Money. Raphael Bostick talking about yesterday that inflation might print a little bit weaker today than what estimates currently are. That sent stocks rallying nicely back up towards the 50-day moving average yesterday. Now that's important. We did get above the 20-day moving average, which has been really confining the markets here over the last week. Broke above that resistance, but failed to get above the 50-day at this point. So again, markets are really struggling here to move higher. Tech stocks outperforming yesterday on this expectation that we might see a little bit of disinflation in the inflation number. Now, again, tech stocks tend to do better in a disinflationary environment than value stocks. And of course, what we saw yesterday is a lot of those inflationary type trend stocks, energy, etc., underperformed yesterday, while we saw technology really outperforming yesterday. Today at 7:30, we're going to see the print on inflation. If that print does come in weaker than expected, we could see some follow through with the markets pushing above the 50-day. Now, if it can get above the 50-day and hold that, and we do see some trends of inflation starting to peak and slow down a bit, that's going to help push markets back up here potentially towards previous highs. The expectation, of course, is that if we have seen an inflationary peak, the hope, of course, from markets is that we will begin to see the Fed back off some of the more hawkish stance of hiking rates and tightening their balance sheet. Now, that's the expectation. I don't think that they will actually do that because, again, what the Fed's bigger concern is being caught at zero if we do have a weaker economic environment, potentially a recessionary environment at some point in the next 12 to 24 months. They don't want to be caught at zero interest rates at that time. So I do suspect the Fed will continue to go through their rate hiking campaign, maybe not 50 basis points in March, maybe 25, and then pace that increase over the course of the year, 3-4 hikes to get to 1% by the end of the year, and begin to taper their balance sheet. That will continue to weigh on stock prices as we get further out into the year. So again, while we may not see a big bear market contraction, which a lot of people have been calling for, we may see a very sloppy market this year with much lower rates of returns than what we've been used to over the last couple of years. And that will certainly seem disappointing, and the volatility will certainly make managing a portfolio a lot more challenging this year. Watching what's happening here with inflation, that's going to help drive markets, at least in the short term. Markets are getting very, very overbought here on a short-term basis, and our money flow buy signal is starting to head up back towards a peak. So while we're seeing this market rally, there's not a lot of fuel in the tank to have a big rally here. So again, if we don't get above the 50-day moving average, we fell at that point. The retest of January lows is still a possibility. If we can move above that 50-day moving average and hold it, there's a decent shot that we could see higher highs here over the next couple of weeks heading into the March meeting if expectations begin to think that the Fed might back off a bit. That's 3 Minutes on Markets and Money. I'm your host, Lance Roberts. Be back tomorrow.